Can you be too early to a trade? Is being too early the same as being wrong? Well, in this video, I want to talk to you about how my brother and I nearly lost $250,000 trading a trade in the dollar yen that we sat in for far too long. And there are a number of lessons that we can learn from this particular trade. Now, this one goes back to the year 2011. The financial crisis had obviously been and gone in 2008, 2009. And as a result of the financial crisis, we had an unwinding of the carry trade. So what happens is in risk-on environments, so prior to 2008, 2009, everybody wanted to deploy their capital. They were looking for yield. They're looking for big returns on their capital. And one of the most straightforward trades back then was the carry trade. You saw this in the dollar yen, the pound yen, essentially currencies that had a high interest rate against something like the yen, which had a very low interest rate. And really there was no possibility, there was no probability that the Bank of Japan were going to raise their interest rate. So it was a one-way trade. It was a very easy trade that everybody jumped on. However, after 2008 and 2009, we had an unwinding of that carry trade. So what happened was the dollar yen and the other yen pairs, they went from their highs all the way down to low. So the Japanese yen strengthened significantly because we were in a risk-off environment and everybody was coming out of the carry trades, which was the one-way trade. And to come out of that trade, obviously, you need to do the opposite, which obviously caused those markets to drop. So here we are in 2011. The market is somewhere around the 80 level. I don't remember the exact numbers, but somewhere around that level. We had the earthquake in Japan at that time, which pushed the market down to 77. And actually, on that particular evening, my brother and I made, 50, 60,000 pounds in just one evening. So that was a story for a different time in any case. But we had that year. Then we also had two central bank interventions, failed interventions, I might say. And that was one of the ways that I learned to trade central bank interventions, was off the back of that. As I saw that a central bank acting in isolation with one-off interventions often wasn't successful. Okay, it wasn't really the catalyst for a trend change in the markets, even though, a lot of traders would think that it was. Actually, an intervention is an opportunity to get in there and trade against the central bank. So that was something that I learned to do then, and it's actually a very successful strategy. But again, I'll talk to you about that in a different video. This one is about being too early. So again, going back to 2011, my brother and I had built up this view that the unwinding of the carry trade was over. The markets were doing significantly better, and eventually, people like the US were going to have to start to look at raising interest rates or stop with their quantitative easing. But the Bank of Japan, they weren't going to do the same thing. So perhaps the carry trade was going to come back into vogue. And we wanted to build a position ahead of time to be able to benefit from that. So there we were towards the end of 2011. And bear in mind, the positions that we traded at the time were very long-term in nature. So they were 3, 6 months, sometimes a year in nature. But even this was actually fairly long-term for us. So we got into this position at the end of 2011. Okay, the market kind of went sideways for a little bit. Eventually, in early 2012, it did break out to the upside. So we added more to our position there. And then the market just sold off. And it stayed towards the lows for about another 4, 5, 6 months after that. Now, our stop was below the ultimate low. So it was around the 77, 78 level. And what we had to do is we had to watch our particular position, neander and do nothing for the best part of 6 months and have over 250,000 pounds of capital tied up in that particular trade, okay, because we were so committed to it. Now, obviously, with the benefit of hindsight, I would have got in a little bit later, would have used more technicals. We were very fundamental biased at that particular time when we were trading for the fund. But essentially, we were sat in that position with the market sort of hovering close towards where our stop was, which, as I said, was nearly over a $250,000 stop there for a long period of time. Now, eventually, when the market broke out, we were able to add to the position and we were able to exit the position at a significant win. So we were able to make a lot of money on that trade. In fact, I think that trade made us close to $600,000 when all was said and done. But for the best part of the year, so we got in, as I said, at the end of 2011, I think it was actually off the back of the last central bank intervention, we thought, oh, this is going to be it. Let's jump in there. And then we got involved some more when we got the initial breakout. The market went against us and we sat in there. And the problem with sitting in this particular trade wasn't just that it was hovering around our stop loss, because you have a stop loss in place to protect your capital. So it wasn't ever going to be catastrophic, okay? The amount of money sounds like a lot of money, but it wasn't in percentage terms of the account. But what it did do is it did tie up margin. It did take away our ability to be as active in other trades as we wanted to be. So yes, we could still maintain other positions in other currency pairs, but actually if we didn't have this capital tied up for all of that time, okay, and we traded more technically. So yes, build that fundamental view, but actually wait for the technical signals to get in and then have shorter term technical signals to get out of the trade. That would allow us to then take away that capital and deploy it in places that we're probably going to be able to make a better return on our investment. So the lesson from this video here is essentially, yes, you can trade with a fundamental view. Yes, you can definitely trade larger position sizes and you can really build into a position and you can make a lot of money in the markets, but also incorporate technicals into your trading to prevent you from getting into a trade too early, because often too early, it can mean that you're wrong. Okay, for us, we were lucky enough that it didn't stop us out. So the market it did kind of form a floor underneath where we were, but we just as easily could have been stopped out because we were too early to the trade. We kind of were committed to it fundamentally. So we built into the trade fundamentally and we didn't pay close enough to the technical. So the way that you want to trade, I would say if you're just starting out, you want to start off by understanding the technicals, add the fundamentals in later. I think that it's a massive asset if you do understand how to trade fundamentals, but it's very difficult to trade fundamentals on your own because you do get into a position where even if you are right on the direction of the trade, if you're right on where it's going to go in the longer term, you could be wrong in the short term and that could cost you money, okay? So I hope you enjoyed this video. I hope you got a lot of value out of it. If you did, please make sure you give it a thumbs up. You also hit the subscribe button and you hit the bell so that you get a notification. And as I say at the end of every video, if you're not already consistently profitable with your trading, then jump across to my website and sign up for my masterclass. I will walk you through my entire trading framework so that you've got a basis to be able to start to trade the markets and to consistently generate profits for your trading account. Okay? Thank you so much for watching, and I look forward to speaking to you in the next video.